Very good morning everyone. How are you? I hope you all are doing good. So, back again to this series of RBI Annual Report analysis. I hope audio video is clear to you. Audio video all set? Just let me know. Audible and visible? All right then, very good. So, again, in the last part of RBI annual report, we have discussed all the things, I think till this point, right? Am I right? We were discussing the fiscal consolidation framework, the fiscal consolidation related performance of Government of India as well as of the state governments in the 23-24 financial year. Right. So, I think we have completed till this point state government's fiscal performance, and we have seen that their capital expenditure has also increased and they have performed well on fiscal consolidation path. Okay. So, we will begin from this point today, Reserve Bank and government securities. From this we will do the analysis. So, let us see what the report has to say. Just a second. What the report has to say regarding government securities, So, there is a very long term, actually not long, it is ultra long security issued by RBI. So, let us discuss about by the government as well. Let us discuss all these things. So, Reserve Bank and government securities. The report says that there is an ultra long security. Ultra long. Why are we calling it as ultra long? It is actually very long, 50 years time period, which is really long time period. So, there is a new government security which is ultra long security has been launched during second half. H2 here means second half, okay. Wherever H1 and H2 is written, it is first half or second half. So, H2 during second half of the 23-24 financial year, there has been an ultra long security issued which is for 50-year period. Remember, this can be asked. This is another important security issued recently. Okay. So, the time period is 50 years security. Amount aggregates to, of this security, amount aggregates to 30,000 crore rupees. 30,000 crore rupees for long-term institutional players, and this is for institutional investors or players. Remember. So, this is first thing in this section that ultra long security have been launched in second half of the of this financial year, which is the duration is 50 year, the amount which aggregates is 30,000 crores, which will be there raised through this security. Okay. And this is for institutional players, remember. This is clear? Now, central government's borrowing, second thing, if we talk about central government's borrowing, again in H2, which is your second half, also included the issuances of new sovereign green bonds for 30 years. So, another important thing, apart from this, I don't know why is it hanging again and again. Okay. So, first thing, ultra long security. Second thing, in the entire borrowing process of the government, that the bonds issued, securities issued, they also work as debt raising instrument, isn't it? So, through government bonds issued, government tries to borrow from the market, isn't it? So, bond is nothing but another debt raising instrument. Debt raising instrument for the government. So, that is what written here is that the central government's borrowing has also included a new issuance. So, now the government is planning to borrow from this new bond which has been termed as your sovereign green bond. You must be aware of this. Another important bond issued recently, right? Sovereign green bond. The maturity period or the time period will be 30 years. How many parts? I don't know how many parts, we are just completing whatever important is there, and let's see how many parts does it take, okay? Because even I don't know how much time will it take to explain all these things, explain the entire report. Yes, second half of that financial year. Second half of financial year, okay. Last 6 months. Clear? So, this is the thing. Now remember, green bond, sovereign green bond. Bond, as you all know, is a debt raising instrument. Government borrows through bonds. And what is this green bond, sovereign green bond? So, bonds generally issued, general bonds which are issued, the money raised from those bonds can be used for any purpose. But remember, when we are talking about sovereign green bonds, the money accruing to the government via this bond, the money raised by the government via this bond will be accruing to, finance the sustainable projects only or the green projects only. So, the money raised through these bonds will be used to finance the green projects or sustainable projects. Clear? This is for your 30 years. The time duration here will be your 30 years. Next, GSEC yields. As we have always, discussed this thing, that in the previous classes as well, we have discussed that GSEC yields have been moderating. Why have they been moderating? Because, tell me the answer. Can you please tell me? Anyone wants to tell me why GSEC yields are moderating? We have seen the trend that government is performing well. RBI has transferred so much of surplus to the government. Also, listing of government bonds as announced by JP Morgan, which we have discussed in our editorial classes, right? So, given all these things, the GSEC market is performing well, and prices, when prices increase, the current price of the security increases or the bond increases, what happens is, households are investing in SIPs. No. See, what happens is in government bond market, yes, price is going up. Very good. There is an inverse relationship between the current price and the yield which you generate from the bond. Isn't it? This is how bond market works. Right? So, prices are going up. Now, why prices are going up? Because we are having more confidence in these securities, although they are secured already, but still they are performing very well. I have told you, we have discussed the reasons. Listing of Indian government bonds announced by the JP Morgan, right? Now, investors know government has money because RBI, government will borrow less, or government has enough to, do fiscal consolidation, as RBI transferred the surplus which we have covered in the editorial classes as well. Yes, inverse relationship. So, given all these things, good fiscal performance, more confidence into government performance, prices increasing, that's why yield falling. This is how bond market works. We have discussed this thing, right? So, this is the thing, and the report says GSEC yields, the weighted average yield moderated to 7.24% from 7.32%. Okay, so it has moderated. That shows rising prices. Okay, and when prices rise, when you have more demand for these bonds and securities. Clear? This much is clear. So, you remember the ultra long security, you remember the sovereign gold bond here, and the GSEC yield moderating. So, this is the trend. GSEC yields are moderating, and on this trend, corporate bond yield, if you remember, corporate, bonds are also performing well on this trend, if you remember from the previous RBI report analysis. Yes or no, right? So, just try to relate all these things. Next is our current and trade account. What does the report says? On current account or trade account of India? So, if we talk about merchandise exports, merchandise means exports of your goods. So, we trade in goods as well as services. You all know that, right? So, when we are talking only about goods, we refer to it as merchandise exports or merchandise trade. And when we talk about, when we will talk about services, it will be your services trade. So, first thing is your merchandise exports. Now, they fell by 3.1% in US dollar term due to global trade volume and commodity price declining. Now, you see, this is a trend which is not satisfactory on part of India, isn't it? Merchandise exports fell by 3.1%. Why Why did they fail? It is not very inherent due to India's economic problems or structures. It is due to global trend only. As you all know that there are geopolitical tensions going on, yes or no? You have Russia-Ukraine war, you have problems in the Middle East, isn't it? So given all these geopolitical tensions and the ongoing global scenario related to trade, so trade volume, contraction in the trade volume has affected India's merchandise exports as well. Isn't it? So this is the thing. Remember, merchandise exports fell and the reasons are due to global trade volume and commodity price decline. At the global level, the trade volume is declining. There are reasons to it. You all know the geopolitical tensions going on. All these things contributed to decline in the global trade value, and then the global trade value also, India is very interlinked to all the economies. So that's how our merchandise exports also got affected. Of course, when demand by other countries decreases, demand for your products, your exports will suffer. So this is something we need to work upon. Remember this trend that merchandise exports have fell according to RBI Annual Report due to decline in global trade volume. Clear? Next, imports. If we talk about imports on part of India, what we have imported, they also decreased by 5.7% in terms of US dollars. Okay, so this data is given here in US dollar terms, not in rupee. Clear? So imports fell, that is a good sign on part of current account deficit, isn't it? So when your imports fell by 5.7%, that shows that your current account deficit would have improved, that you have more favorable trade balance, or if not favorable, you are performing good by reducing your dependency on imports, isn't it? Right? Then if we talk about merchandise trade deficit, so by now, since we have discussed what is trade deficit, you know what is deficit? When your exports are less than imports. This is your trade deficit. And what is merchandise trade deficits? When your exports of goods only, not services. When your exports of goods are less than the import of goods. Okay. So what does the report say regarding merchandise trade deficit? It has narrowed to 238.3 billion US dollar from the earlier 264.9 billion US dollar. So merchandise trade deficit has narrowed. Isn't it a good indicator? Yes or no? You should remember whatever is there in the RBI annual report. This is authentic source. Okay. You should remember whatever fact is there in the report. I think that would be more helpful, because also you can quote this, you can write that this data, whatever you write in your descriptive paper particularly, you can write that this has been taken from RBI annual report, or on the basis of RBI annual report, this is the trend. Clear? Okay. Now tell me, don't you agree that falling of merchandise trade narrowing of merchandise trade deficit is a good indicator? Quickly, yes or no? Good indicator. Right? Because when your trade deficit narrows, it means you are reducing upon your deficit, which reflects that your imports are decreasing and exports are rising. Although you might still have negative trade balance with that country, but still you are performing well on your exports front, isn't it? Very good. So you all understand by now that what happens when we talk about narrowing of deficits, what is current account deficit, all these things. Very good. Okay, so this is the scenario, merchandise trade deficit narrowing down, good indicator. Then current account deficit. You all know what is current account deficit. Total goods and services exported minus goods and services imported, right? So exports of goods and services minus import of goods and services. So here we have both merchandise as well as services trade. So what is current account deficit status? It has also moderated. Now you see, this is very obvious. If your imports are decreasing, if your imports are falling, if your merchandise trade deficit is narrowing, that would reflect into your current account deficit, isn't it? So current account deficit has also moderated to 1.2% of GDP. 1.2% of GDP, and this data is based on your April-December month for 2023. From earlier 2.6 in the same period a year ago, supported by robust services exports and steady inward remittances. Now these are important. So by now you understand this trend, that according to RBI annual report, what is the trend on current account deficit for India or trade balance. So current account deficit is being moderated. We are performing well on exports front. We are trying to reduce these deficits, the difference between exports and imports. Now what two broad factors have contributed to this narrowing down of current account deficit? First, given here as per the report, is services exports are robust. Services exports are robust. It means that export of services are making your deficits decline. They are contributing to your current account deficit, narrowing the current account deficit. So services sectors performing well, you all know. Service exports rising plus steady inward remittances. India is also receiving remittances from abroad, from all over the world, from our non-resident individuals, NRIs, PIOs, all these individuals. Understand that, right? So steady service export, incoming remittances into India, they have placed the current account deficit, resulted into current account deficit perform good. One question to you all, always remember, if you are asked to classify an given component into current account or capital account, remittances constitute a part of what? Current account or capital account. Remittances which we receive, as you know, the funds or say the amount sent by our non-resident Indians or PIOs, all these entities, is taken into consideration in current account or capital account? Current, very good. So you have to be sure about this. It is in current account, okay? Current account transfers. It is a transfer income, also remember. It would be noted as current account transfers because it is a transfer income. What is a transfer income? Which you earn by not performing any economic activity against it. So there is a difference between factor income and transfer income, isn't it? So remittances are transfers because they have transferred that amount to say some relative residing in India. That relative has not performed any economic activity. So these are known as transfers in your current account. Clear? Okay. So this is the thing regarding, trade and current account. You should remember all these things. Current account deficit narrowing down. Now when we talk about capital flows, you all know that foreign investment is very necessary for growth, domestic as well. Also government is continuously trying to attract more of foreign investments, isn't it? So what is the position of FDI, FPI incoming into India? Let's see the position as per the RBI report. So if we talk about capital inflows which were there in 23-24 financial year, robust inflows. The first very word makes it clear that India has been able to attract robust or huge amount of capital inflows, which shows that internationally investors are having confidence into Indian economy, which in turn shows that Indian economy is performing really well. Yes, very good. You remember that question answer series? It is highest from which country? Singapore FDI. Okay. So robust inflows, okay, attracted by strong economic growth. Why does a country has robust inflows? Strong economic growth. As you all know, India's growth is projected to be higher for the upcoming financial year as well. We have had a good GDP number, a good GDP percentage over the last financial years as well, isn't it? So strong economic growth increases investors' confidence into economy, and then you attract more of investments in form of say capital, foreign capital coming to India, and improving macroeconomic fundamentals. All your macroeconomic aggregates, your GDP, inflation you are trying to balance in the, as you all know, the RBI is continuously trying to keep up the inflation within the desired limits. So all on CAD, current account deficit, you are performing good on current account deficit, able to reduce it not to increase it along with your growth. This is a good combination. Remember, you are growing simultaneously, you are able to cut down on your current account deficit. It means you are able to perform well or manage well on your macroeconomic fronts. These all are your macroeconomic indicators. Clear? So this is the thing. Next, particularly if we talk about foreign portfolio investment, FPI, foreign portfolio investment. You all know what is foreign portfolio investment, right? So broadly, when we see the foreign investment coming into India, one is FDI, direct investment. Another one is foreign portfolio investment. Yes, global bond index also attracting FDI. Very good. So you are following, you are keeping up with the news as well. Okay. Foreign portfolio investment, foreign investment in your securities via your securities and related financial assets, right? This is foreign portfolio investment. So FPI, net incoming FPI, net is your incoming versus minus outgoing. Okay. So net is your incoming, when you subtract your outgoing from the incoming, that gives you net. So incoming FPI reached say $41.6 billion, which is second highest since 2014-15. So India is attracting really good amount of foreign portfolio investment. You see, it is second highest since 2014-15. Clear? So this is the thing. FPI also increasing in India, coming more towards India. India received the highest net FPI and inflows among all its peer emerging market economies, EMEs. So this is indicative of Indian economy's strength. Among all the peer emerging market economies, India received the highest inflow of foreign portfolio investment. Remember this. This is important. Okay? Understood? Now, when we talk about the foreign direct investment, FDI, so again FDI, the gross flows, stood at 71 US billion dollar, comparable to 71.4 billion previously. Net FDI has moderated to 10.6 billion due to higher repatriation. Now FPI, India receives the highest. FPI, in terms of FPI, India has received the highest among all the emerging market economies, as you can see here. But there is something problematic with this FDI. So net FDI, net incoming FDI has moderated rather than increasing. Why it has moderated? The reason given here is higher repatriation. You know what is repatriation? Repatriation is sending back something to its source of origin. So you all know that recently in one of the editorials I discussed with you that investors are trying to book some profits due to election results and all these things. Volatility was there. There was suspected volatility in the stock market as well. So investors try to book certain profits by pulling out their some amount of money, not the entire one. So that money got repatriated to their source of origin from the countries from which they came to India. Getting my point or not? Right? So it is due to these repatriation activities that they try to book certain profits in order to mitigate loss, if any, if it occurs, that these net FDI numbers show that it has moderated in case of India. Have you understood this thing? Yes or no? I hope you have understood, right? We have discussed an entire editorial on this. That can also be due to high Fed rates. Yes, of course. That affects your market as well. You know that there are high interest rates announced by Fed Reserve as well. So there is capital outflow. That can also be one of the reasons. Okay. Yes. So capital outflow is there, but the reason attached here is repatriation particularly. That's why I explained you in that term. Okay. Capital outflow is there, of course. Indeed. This is the situation. Okay. Now, moving ahead, other major capital flows. What is the situation regarding other major capital flows? So you see, this is something which we have talked about in terms of FPI and FDI, but there are something some other major flows which also come to India. So if we talk about external commercial borrowings, ECBs and non-resident deposits, they were higher during the year. So your ECBs and non-resident deposits were very high. Now what are non-resident deposits? As the name suggests, the deposits of non-resident Indians or non-residents of India, which constitute your NRIs and PIOs, isn't it? So their deposits with the account which they open up with the authorized dealers from India, like your NRE account, NRO account, FCNRB account, all these type of accounts. So non-resident deposit money has increased. They have deposited more into their non-resident accounts. Okay, first thing. Second thing here is external commercial borrowing. What is external commercial borrowing? Another important concept that forms a part of your capital account BOP. Remember, external commercial borrowing or ECB is a component which is included in capital account head of the BOP, not in the current account. Remember, okay? So external commercial borrowing is, as the name suggests, borrowing for commercial purposes by resident entities from India, from outside the India. So eligible, which are, eligible as per the RBI guidelines or set of regulations, which are authorized by the RBI to borrow from outside. So all those resident entities borrowing from outside India for commercial purposes, which are eligible to borrow from outside, constitutes your external commercial borrowing. Have you understood what is ECB? Right? And also remember, ECB forms a part of capital account BOP. All your borrowings are there in the capital account BOP, not in the current account BOP. Is that okay with you? Understood what is ECB? So ECBs and non-resident deposits have also improved. Okay. Next, foreign exchange reserves. You all know, we need not look even at the report for foreign exchange reserve situation of India. Foreign exchange reserves of India are being, increased. They are increasing and they have been exuberant recently. So you all know this trend already. They have increased by 32.9 billion US dollars, and that is during April-December 23 on a balance of payment basis. So we are saying on the BOP basis, excluding the valuation effects. Remember here, this thing that foreign exchange reserves are performing well, they have increased. This value which is shown that they have increased by 32.9 billion US dollars does not include the currency or foreign exchange fluctuation effects. So valuation effects are excluded here. This is exclusively mentioned in the report. Valuation effects are excluded. Clear? So your currency exchange rate changes, so currency value changes, those are excluded here. So, and that then the figure has been given to you. Clear? Then reaching an all-time high of $648.7 billion, covering 11.4 months of imports and strengthening buffers against external sector risk. So you all know that foreign exchange reserves of India are presently at all-time high, which we have seen in the history of foreign exchange reserves. Isn't it? All-time high. Why? So you know all these things. India performing well on trade front. You know all the reasons, right? Exports boosting, service exports boosting, imports declining, we are earning more FDI coming into India, Indian government bonds getting listed into international, bond indexes announced by JP Morgan, all these things, given all these things, your foreign exchange reserves are rising, isn't it? Okay, so this is the thing. Now when your foreign exchange reserve rise, they provide you buffer against any future risk to the economy. Buffer against any external risk, right? You have enough of foreign currencies. Even if you need to import something immediately and that causes a huge import bill, you will be able to do that. Also, when you have enough foreign currencies, the RBI will be able to manage the float. The managed floating, which I explained to you, then when we try to deliberately affect the value of our domestic currency via selling and buying of the foreign currency in the market, it is known as managed floating. So when we deliberately try to say depreciate it, which is known as devaluation. So what does RBI does? It sells out US dollar in the market so that US dollar supply increases, demand remaining constant, supply increases, price falls, so exchange rate falls. Isn't it? So it will help in all these fronts. This is a good indicator. Clear? Now when we talk about the banking sector, what has been the performance of Indian banking sector as per the RBI annual report? So first you have this data related to your scheduled commercial banks. First thing, the capital adequacy has been above regulatory minimum requirement as per September 23. This is good. You all know what is capital adequacy, right? Capital adequacy is the minimum, capital which the bank should have in order to absorb any future losses or avert any future risks, which should be there with the bank in order to cope up with any unprecedented risk or loss. You all know that, right? And we have discussed what is capital adequacy ratio. Capital adequacy ratio gives you how much adequate capital do you have in comparison to your total risk weighted assets, so that you are able to stand by any financial crisis, loss or unprecedented risk. Yes, tier 1 plus tier 2 capital divided by total risk weighted assets. Okay, so exact formula of capital adequacy ratio would be tier 1 plus tier 2 capital. There is classification of capital into tier 1 and tier 2 as per the Basel norms. So tier 1 plus tier 2 capital divided by your total risk weighted assets. In simple terms, what is it? It gives you the ratio in comparison to your risky loans, how much adequate capital. Assets also includes risk weighted asset, includes the loans given by the banks, also their other assets. Remember, other assets as well. So how much adequate capital do you have in comparison to these loans and assets, so as to absorb the future shock if there is any. Clear? So and what is the present CAR requirement for commercial banks in India? It is 9% as per RBI guidelines, right? You all know that CAR presently is 9%. Isn't it? Right? So they have this capital adequacy above the regulatory minimum, which is 9%. So above the requirement. That is a good sign that banking systems are safe. Banking system is safe. Isn't it? Second, credit growth. If we talk about the growth of credit, how much credit is being extended by the banking sector in India, it has sustained momentum. It has sustained the momentum. So it is going with the flow, increasing gradually, not very significantly, but it is, keeping up the pace with the overall growth rate. That is the thing. Next, asset quality. What is the quality of your assets which you hold, which includes your loans plus other assets? So the asset quality in banking system, you all know that loan is an asset for the bank, isn't it? So loan including other assets which the bank holds, all other assets plus loan. The quality of these assets lying with the banking system has improved. This is good. It has improved. And why it has improved? Because your NPAs are declining. And loan is an asset. When your bad loan is declining, that means you are performing well on the asset quality. Your loans given are less defaulting now. You can understand this in this manner. Okay, so your gross NPA is on a declining trend given sustained efforts of the government of India and the RBI. You all know there are sustained efforts going on to reduce NPA from the banking system, isn't it? So given these efforts, your asset quality in the banking system has improved, which is a good indicator for banks' safety and enough liquidity. Clear? Now, profitability indicators. If you look at these are something, capital adequacy, asset quality, falling NPA are indicative of less risk or less vulnerability of the banking system to any risk. This is indicative of less vulnerability. Okay, but if we talk about the performance, what about the performance of the profitability of the banks? So if we talk about the profitability, there are certain indicators which reflect is the bank profitable or not. right? So profitability indicators like return on equity and return on assets, they were also robust. It shows that that the banking system is also having good profits. Apart from having adequate liquidity, adequate assets or capital, it is also able to generate good amount of revenue or profit. This is the thing. Now, what are these terms? Again, very important concepts. Return on equity, return on assets. These are profitability indicators. Return on equity. You all know what is equity? Initial capital which is invested into the banking system. Okay. So, return on equity will be your ratio between net income and your, say, shareholders equity or initial capital invested. So it is the ratio between net income of the bank and the initial capital invested. So from here you can see that return on equity is showing how much your capital or assets are able to generate profit or revenue for the bank. How much income are you able to generate out of these initial capital being invested or from the shareholders equity, whichever way you look upon it. Isn't it? So it shows how much your initial invested capital is able to generate revenue and profit for you. This is the ratio. Return on equity, net income of the bank divided by initial capital invested. Yes, you are right here. There were technical write-offs. We will discuss it later. It will be coming into the report, right? So you have understood what is return on equity? Tell me quickly. Right? Then there is another term, return on assets. Similarly, net income divided by the total assets available with the bank. Okay, so it gives you an indicator of how much are you able to generate revenue and profits out of your assets. How much profit, revenue are the banks able to generate out of their assets. So it is return on assets is your net income divided by assets of the bank. So these indicate the profitability of your assets, of your capital invested into your banking system. Have you understood these two terms? Return on equity and return on assets? Yes or no? Let me know quickly. Yes? Right? Simple. Net income divided by initial capital invested, net income divided by assets. Good. So these are profitability indicators. They have performed well. It shows that banks are able to generate profit as well. Isn't it? That is good. Then macro stress test for credit risk suggests that scheduled commercial banks would be in a position to comply with the minimum capital requirements both at the aggregate and individual bank level even under a severe stress. So given all these performances, अच्छी profitability is there, right? Good profitability, adequate capital adequacy ratio above the minimum requirements. All these are indicative that our banking system, you consider them at the aggregate level given the entire banking system, or you consider them at an individual level. You look upon at an individual bank, they are or they will be, the report says, their performances says that they will be able to sustain any severe stress. So that is a good indication for Indian economy that congratulations, you are immune. Yeah, the banking system is immune to these risks. Okay? Clear? So they will be able to stand by any severe stress if it occurs in future. Understood this entire banking sector scenario? Alright, now moving ahead. If we talk about the NBFCs, the scenario with the NBFCs, non-banking financial companies, you all know what are non-banking financial companies, right? They cannot accept demand deposits, they can only accept term deposits, they do not form part of payment and settlement system, their deposits are not covered by insurance given by DICGC. All these differences are there. Now, non-banking financial companies. So far we have discussed about the performance of banking system. What about NBFCs? Another major financial institute. NBFCs capital adequacy, if you talk about, so these are comfortable. Not increased hugely, not increased substantially, but are comfortable. Need not worry about that. Okay. Second, asset quality. What about the quality of their loans? What about NPA in that sector? So asset quality for NBFC has also improved. Okay. Asset quality for NBFC has also improved, as it was the case with the banking system. Now, this shows that they are also less prone to risk. Okay, they have enough to absorb the shock. This is different from the profitability front. Now, let's see on the profitability indicators. On the profitability front, if you look at these terms, ROA, return on assets, as we have discussed for the banks, net income divided by total assets of the bank. So, how much are you able to generate profit out of your assets? What is the return on your assets, right? So, ROA, which is the profitability indicator for non-banking financial company, first this thing, next net interest margin also, they stood strong, and cost to income ratio improved. Now, there are 2-3 terminologies here. I have already explained to you what is ROA, return on assets. It is strong, which means NBFCs are also able to generate or book profits. Clear? Second thing mentioned here is net interest margin. Net interest margin. What is net interest margin? Net interest margin is interest income which the banks earn. You know, bank provide loan on a certain interest rate, so they earn some interest. So interest income earned by the bank minus interest given by the bank. So bank also gives interest on your deposits and all these things, right? So the difference between what you have earned through interest and what you have paid as interest is your net interest margin. Understood? So that also stood good, which is reflective that NBFCs are able to generate more income through interest as compared to what they are paying as interest. Isn't it? Understood? Net interest margin, right? So it also stood strong. Then your cost to income ratio for NBFCs is also improved. The cost undertook the NBFCs, entire cost which were undertaken by the NBFCs are now not greater than the income. So cost to income, whatever cost you have income, in comparison to that cost, if you see the ratio, income is generating. So your assets are able to generate income. The cost to income ratio is performing good. Okay, you are able to generate enough of income and compared to what you have invested as, or what the cost which you have undertaken in your system. Have you understood these profitability indicators for NBFCs, right? Net interest margin, ROA, and all these cost to income ratio. Net interest margin, interest earned minus interest paid. Clear? Okay. I hope you understood all these things. Now, moving ahead. If we talk about the urban cooperative banks, so they have witnessed an improvement in their capital adequacy as well. So not only the commercial banks, the scheduled commercial banks and the NBFCs, but urban cooperative banks have also performed well. Okay. Cost to income ratio. Cost to income is, there is cost to benefit analysis which you do while studying the syllabus of any examination. It is like this. So you try to find out that which areas, if I focus upon, will give me more marks in the exam. Cost to benefit analysis. My cost is my time which I am giving to study that syllabus. So cost incurred by these institutes versus what they accept in relation to that cost as return, as income to them. Understood now? So take it as cost to benefit analysis, which we all do before any examination for studying or covering the syllabus for any examination. Okay? Alright. So urban cooperative banks we were discussing. Urban cooperative banks also have a good capital adequacy with their capital to risk weighted assets ratio CRAR surpassing the minimum requirement. So they also have surpassed their minimum requirements. Okay. I would appreciate if you tell me what is the minimum requirement of CAR for urban cooperative banks. Alright. So you look into it. What is the minimum requirement for urban cooperative banks? Okay, 15%. So this is the thing. This is, we have seen the capital adequacy 12%. So varying rates. Okay, I'm waiting for further responses. Here you see we have discussed the banking performance, also the performance of the non-banking financial sector, and the performance of urban cooperative banks. So you are able to understand that they are performing well on liquidity front as well and on profitability front as well, isn't it? So this was your regarding non-banking financial companies, banks, and the entire banking system. You have learned new terminology, so remember them: ROA, ROE, net interest margin, all these things. Clear? Now moving ahead. Now focus on these regulatory guidelines. What have been issued by RBI for all these sectors? You know, for all regulated entities, be it banks, be it NBFC, be it any financial institute which is there, you know, as supervised entity or regulated entity, what are the regulatory guidelines issued for them recently in the 23-24 financial year? This is again very important. Okay, so we will discuss it later or in the next class. Just focus here now. Regulatory guidelines. So another segment is your regulatory guideline for the banking sector or all the regulated entities and supervised entities, be it a bank, be it an NBFC, be it any financial entity. Understood? So what are these? RBI, as you know, is becoming is very prudent in these regulations because we want our banking system to be protected and to be resilient, isn't it? So what are these guidelines mentioned as per the RBI Annual Report? First thing which we did is issued, you know, these guidelines were issued to strengthen governance, risk management and capital buffers. Why did RBI issue these guidelines? These guidelines were issued to strengthen the governance of all these financial entities, right? Second, to manage the risk which is prevailing in these sectors. So it is the result of these guidelines, continuous efforts of RBI and Government of India that we are able to see a decline in the NPA, improvement in the asset quality, right? And also to have adequate capital buffers, and you know that we have. They all are maintaining capital buffers or adequate capital adequacy is there above the minimum requirements. So it is there. It is the result of these guidelines and strengthening measures undertook by central bank. Clear? So now let's see what are these guidelines which were issued. Particularly these guidelines are written. So again this becomes important. These regulatory guidelines for all the financial institutes by their regulators, they first included default loss guarantee in digital lending. Default loss guarantee. What is default loss guarantee? So basically default loss guarantee says when you are engaged in digital lending, not in person to person, physically, okay? In digital lending, if there is any loss to the bank due to default on the loan, if there is any loss to the bank or the entity, whichever concerned entity is here, financial entity, loss to that lending entity on account of default from the borrower, that will be covered. You will be provided compensation for that loss. So this is important. Why it has been issued? To maintain adequate capital buffers in the banking system, in the system liquidity, to maintain the system liquidity. Understood? So default loss guarantee, you will be provided that amount if you incur loss due to default of the borrower on that loan. Understood? Right? Yes. So it is given by RBI, it is provided by RBI as per the regulatory guidelines. Okay. Understood till here? Now next, framework for compromise settlements. Also RBI has issued framework for compromise settlements. What are these compromise settlements? Okay, remember these basic terminologies which I am simultaneously explaining to you. They are important. You will be able to, when you read the report again, you will be able to understand everything and you will be able to remember the facts then. Okay, what is this compromise settlement and technical write-offs? Technical write-offs. So new frameworks, new guidelines are being continuously issued for compromise settlements, for technical write-offs. So RBI is looking at on these indicators as well. What is a compromise settlement? So there is a term called haircut. You all know what is a haircut? Do you know what is haircut? Respond quickly. What is haircut? What is haircut? So it is not the hairdo, okay, it is, मैं तो बताऊंगी ही, I'll tell you what is haircut. I'm just trying to understand, do you understand this term or not? Do you know this term or not? Margin. Baal katna? No, this is not the haircut which you do at the salons or at the parlors, okay? This is not that haircut. This is an interesting term. Haircut in finance means, remember, that's why I discussed with you. Okay, so I'm telling you what exactly haircut is, right? So this is not the cutting of the hair. Haircut in finance or in banking means, say there is a bank, try to understand it, focus upon this. There is a bank and bank has given loan to someone. Now that loan is on a verge of default or it has defaulted, say, okay, it has defaulted. Now as we say that having something is better than having nothing. Okay, something is always better than nothing. Now if the borrower is able to pay at least some amount of it, or the bank is able to recover at least some amount of that loan which the bank gave, the bank will compromise with that amount and will forego the remaining amount. That compromise in the actual value which you were to generate from that loan and what you have generated from that loan is the haircut. So the compromise which you accept, because you know it will default entirely otherwise. So at least have something. Having something out of that loan, recovering some part of that loan is better than recovering nothing, isn't it? So that compromise, what the bank accepts, what the institute accepts, that decline in the value is the haircut. Understood, everyone? This is known as haircut in finance. Understood? Okay. Right? So this is the thing. This is the thing. This is haircut, and these are your compromise settlements, that you compromise upon the value so as to recover at least some part of it, some part of the loan, right? So RBI has issued frameworks, guidelines for these compromise settlements as well. It shows that RBI has an eye on these things, right? And technical write-offs as well. So now technical write-offs. What is a technical write-off? You need not go into detail what are these guidelines for compromise settlements, no. It's just that you remember in the report it has been written that RBI is working on these fronts as well. Okay, compromise settlements, as you know, haircut I have explained to you. Technical write-offs. What are technical write-off? Writing off loan only on accounts, not waiving them off, only for clearing your balance sheet. So there is a loan which is to be, or the borrower has defaulted, say, okay, on which there is NP or the borrower has defaulted. So what banks do for accounting process only, for the process of accounting, they write it off technically, not actually. What does it mean? You have written off that loan to clear your balance sheets, but the loan still is outstanding on that person. It is not waived off. This is what we call as a technical write-off. This is what we term as a technical write-off. Yes, it's just a clearing of balance sheet procedure. Not the actual amount has been waived off. It is still outstanding on that person, whosoever has the loan outstanding upon him or her. It's just to clear the balance sheet due to for the accounting process. It has been written off technically. These are known as your technical write-offs. Understood? So guidelines and frameworks have been provided for them as well. Next, prudential norms for classification, valuation, operation of commercial banks' investment portfolios. RBI is also very keen on watching the classification, valuation and operation of commercial banks' investment portfolios, whatever investment portfolios they are indulged in, or whatever investments they are doing or they are engaged into, right? So what is the value of those portfolios? What is the valuation? What is the classification? In which all instruments are you investing? What is the operation? How much are you able to generate out of them? All these things are also being looked at by the RBI. Clear? Next, minimum capital requirement for operational risk. Continuously having an eye on minimum capital requirements. If there is an operational risk, you have to have sufficient capital requirement in order to avert or face that operational risk as well. That can be a high chance of that loan getting turned into an NPA. In that case, the ARC will have to intervene. That bank will have to sell that loan to the ARC, Asset Reconstruction Company. Yes, it might turn into NPA. Okay, so this is the thing. Okay, now establishment of an umbrella organization for urban cooperative banks. RBI is also looking at framework for establishing an umbrella organization for urban cooperative banks. Okay, urban cooperative banks. These are certain regulatory guidelines which RBI is continuously working upon for the sector. Next, released draft disclosure framework. Draft disclosure framework on climate related financial risk for public consultation in February 24. Now this is very important. Try to understand what is this. Very, very important. It is through this draft that the RBI is trying to integrate or to accept that climate change has a risk in the banking system as well. Why? There is a climate related risk in every asset now. Due to climate related risks, there are risks in several sectors in the economy, isn't it? There are risks in performance of every sector. Risk in what you export will be imported with higher tariffs, as we have seen in earlier editorial classes in some other countries. So there is risk on economic performance front in every sector due to climate change. Now what RBI is trying to do is, through these draft disclosure framework on climate related financial risk, RBI is trying to provide a framework where every information will be there so that the companies, investors, all these asset holders can access that information so that they do not misprice, misvalue their assets. They do not misallocate their funds into something which is risky on the basis of climate risk. So are you able to understand this? RBI is trying to have an information disclosure system which would be comprehensive, which can be accessed easily by everyone so as to mitigate the climate related risk in the financial assets. Understood what is this draft disclosure framework? So disclosure of the information related to climate risk in the financial assets on climate related financial risk. So this is what the draft talks about. It is in the process, and RBI has released the draft. So RBI is working on this front as well. Tell me, have you understood this, right? Yes or no? Yes, no? Any responses? Yes, good. So you have understood, right? These are some of the regulatory guidelines for the regulated entities. These are for regulated entities. Now, guidelines for supervisory actions, what are there? What are the supervisory actions which have been in news in 23-24? So, active engagement with supervised entities. Now, what are these supervised entities? Supervised by their supervisors or regulators. These might include your banks, might include your NBFCs. So, all these financial entities, there is active engagement with these entities to ensure governance and compliance with guidelines. The regulators, financial market regulators, banking sector regulator, they all are actively engaged with these supervised entities to ensure governance and that they comply with the guidelines, latest guidelines being issued by these regulators. Okay, right? So this is the thing. Now next, comprehensive on-site cyber risk assessment. Also, we are continuously trying to have a comprehensive cyber risk assessment. You know, cyber risk is a huge threat to the banking system or to the financial system, isn't it? So including all your major supervised entities, which includes your banks, NBFCs, other financial institutes, we are trying to have a comprehensive on-site cyber risk assessment for all these supervised entities. Okay. Also, the RBI and related regulators of different sectors, they are planning to expand IT examination, information technology related solutions, to include more urban cooperative banks. More IT solutions and examination of their performance to be extended to urban cooperative banks as well as to some selected NBFCs, So now more RBI is trying to increase its ambit of regulation and supervision to that too based on scientific innovation technologies, IT technology for the urban cooperative banks as well as for the NBFCs. Understood, right? Next, implemented Daksh portal. You all know what is Daksh. So Daksh is a web-based portal launched by who launched the Daksh portal, which is a super tech tool. Who launched the Daksh portal? This is very important current affairs. You must know about Daksh. So Daksh is a web-based portal used by RBI, basically, you know, to increase the compliance system, to supervise the compliance. Yes, very good. To supervise that they are complying with all those guidelines or not. So it is a compliance system. It is a web-based system which enables the RBI to supervise all these entities, regulated or supervised entities, on their compliance front, whether they are complying with the latest guidelines and norms or not. Clear? So this is the Daksh portal, web-based portal. Also the RBI extended prompt corrective action framework, PCA framework, to some of the NBFCs. You know, NBFCs are now included in this PCA framework, except those in the base layer. From October 24. Now, what is this information? First, what is PCA? Prompt corrective action, PCA framework. This was launched in 2002 by the RBI. PCA framework is not a very recent one. It was launched in 2002. So prompt corrective action, you know what happens is, consider it like this. You get ill, okay? If someone gets ill, gets admitted to the hospital, the doctors take care of you, the nurses take care of you. Now you are well off, then you are discharged. This is the situation. Same happens for banks or other financial institutes. If they are not performing well, if the RBI perceives any risk in the bank, in a bank system or a particular branch of the bank, need not necessarily the entire bank. If the RBI, you know, smells some risky management over there, smells some lesser performance or bad performance of those branches or banks in terms of capital adequacy, risk management, all these things, it keeps them into PCA framework and tries to correct the situation, tries to redirect those banks and branches to perform well again. And once under PCA framework with stricter guidelines and all these norms, they start performing well, their health gets starts improving, they are discharged from the PCA framework. So this is how. Understood? So remember this hospital phenomena, that someone who is ill gets admitted to the hospital. So if bank is ill, gets admitted into PCA framework, RBI recorrects everything through its framework and then releases or discharges the bank from the hospital or from the PCA framework. This is your prompt corrective action framework. I hope you have understood through this example. Yes or no? Yes. So now this PCA framework has been extended to NBFCs, because you know NBFCs are also indulging, we are witnessing higher risk in the NBFC sector as well, given last few years trend. Yes or no? So this framework now has also been extended to NBFCs, but here something is written except the base layer, except the base layer. Now what is this layering of NBFCs? What is this layering? So this layering is basically, you know, NBFCs have been classified into 4 broad layers, right? 4 broad layers. So here under the prompt corrective action categories, yes, prompt corrective action, base layer NBFCs will not be included. Now what are these layers? Try to understand or remember. So your NBFCs broadly have 4 categories, okay? The base layer, okay, base layer, the middle layer, the upper layer, and the top layer, okay? Now there are several criteria to classify them into these categories, but broadly remember, the base layer NBFCs will be those who have, you know, total net worth, their net worth is say less than 1000 crore presently, 1000 crore rupees, less than 1000 crore rupees under net worth is your NBFC for base layer, okay? 1000 rupee or above, 1000 crore rupees or above will constitute your middle layer NBFCs, okay? And upper layer will be decided by the RBI. RBI feels that there is an NBFC which is risky, will be kept in based upon the risk. So this classification is based upon your risk, upon your assets, upon your activities, all these indicators, right? One more thing, remember, very important trend, very important which you should notice here, that as we move from bottom to up in this categorization, from base layer to the top layer, the risk will increase. Remember, risk will increase. So base layer NBFCs are those having the lowest risk, and the top layer NBFCs are those having the highest risk. Clear? And the top layer is ideally kept empty. Remember, it is ideally kept empty, no NBFC. Why kept empty? Because whenever the time arises or the need arises, RBI feels that there is an NBFC which is very risky, which has very higher risk in its performance, in its asset quality, then it will be kept in top layer. So it is ideally kept, you know, empty as of now. That would be that NBFC with highest risk will be placed under this layer. So now you have understood this categorization. So why base layer NBFCs have been excluded from PCA framework? Because now you know that they have the least risk and they have the highest risk. So if we move upon in this direction, risk increases. So here base layer NBFCs have the lowest risk among all them. That's why they are excluded from PCA framework, which is now extended to NBFCs as well by RBI. I hope you have understood this now. Why base layer NBFCs have been excluded? What is this categorization? Remember, top layer kept empty. NBFCs will be included in this layer when they are very risky, as the RBI feels so, whenever the need arises, right? So this is clear to you, right? This is the categorization, and that's why, you know, that's why the base layer NBFCs are kept outside from this PCA framework. Other NBFCs are kept in PCA now. So remember, NBFCs are now also covered under prompt corrective action. And remember that hospital example which I gave you. What is PCA framework? Okay. So we have discussed so far these very new terminologies, interesting terminologies. I hope you were able to understand all of them, whichever concept was there in between the analysis. Next, in the next class, I will take up from central bank digital currency, another important area, and you know that RBI has launched a pilot project for this. So now the central bank digital currency is available as the token in form of the legal tender. You can buy them from the authorized banks, which are your Yes Bank, SBI Bank, ICICI, and all these banks. right? So that can be bought. So it has been rolled out as a pilot project in the phase manner so as to understand whether is it going to work or not, what will be the risk, in the system, or what needs to be improvised upon, all these things. So the pilot has been launched, which we will be discussing in the central bank digital currency section. So far we have discussed till this PCA framework being extended to NBFCs, excluding base layer NBFCs. In the next class I will be taking up from CBDC or central bank digital currency part. This would also be very interesting. It is, central bank is continuously in the process to have digital currency. We will understand what is a digital currency, is it related to cryptocurrency, what is India's present state related to digital currency, all these things in the next class from here. Any doubts so far? Any queries? Questions? No? So I hope you have understood all these things. It was useful for you. We will continue the discussion in the next series. Okay? So we will continue it in the next series. I hope you understood this. Okay, we have some doubts. If you can share your qualification, great knowledge of concepts in economics, finance, banking, etc. with good communication. See, I appreciate that you have a keen interest in knowing the education qualification. But since you can guess that I'm an economics graduate, and so I have a keen interest in economics. That's why you see these terminologies which I talk about with you. So just a second. But I won't address any personal questions, okay? Because otherwise, I won't address any personal question. I can just give you a hint that since I'm teaching economics, so I'm an economics graduate and pursuing economics masters as well, right? So this is the thing what all I can share with you. No more personal questions, please. And thank you so much. Okay, CRAR target I will take up tomorrow. I'll discuss with you the CRAR target. Tomorrow means in the next session of the RBI class. Alright, thank you so much. You are liking these lectures. That's what we want to have, okay? If you are able to understand these complex terminologies related to finance and economy, that's how the hard work gets justified. So very good. Keep on revising these concepts, keep on revising the facts as well as the basic concepts. I'll see you in the next session, next lecture of this series. Till then, have a very good day. Thank you so much for staying focused for so long. Thank you so much. Have a good day.